This weekend may end up being remembered as far more than another geopolitical headline. While many investors were focused on the latest movement in gold, silver, and crude oil, a much larger question quietly emerged beneath the surface. Are financial markets accurately pricing the risks ahead, or have they become too confident that recent progress toward stability will continue uninterrupted? That question matters because markets don't move on today's reality alone. They move on what investors collectively believe tomorrow will look like. When those expectations change suddenly, prices can change just as quickly. For much of the past several weeks, the dominant market narrative has been straightforward. Easing tensions in the Middle East encouraged traders to believe that global energy supplies would normalize, shipping routes would become more reliable, inflation pressures would continue fading, and central banks would eventually gain more flexibility. Those assumptions supported a stronger US dollar, firmer real yields, and a broad repricing across precious metals. On the surface, that sequence appeared logical. Oil prices declined sharply from earlier highs as markets anticipated improved transportation conditions and fewer supply disruptions. As inflation expectations softened, government bond yields adjusted, currency markets responded, and investors shifted toward assets offering higher yields. Gold and silver, which generate no income on their own, came under pressure as the opportunity cost of holding them increased. That relationship is well understood among institutional investors. Higher real yields generally reduce the attractiveness of precious metals. A stronger dollar makes commodities more expensive for international buyers. Together, those forces often create meaningful downward pressure on gold and silver prices, even when their longer-term fundamentals remain unchanged. But financial markets rarely remain static. Just as confidence in a more stable geopolitical environment was becoming widely accepted, new military developments reminded investors how quickly conditions can evolve. Reports of direct military exchanges involving the United States and Iran immediately shifted attention back toward one of the world's most strategically important energy corridors. Whenever tensions rise near the Strait of Hormuz, markets pay attention for one simple reason. A significant share of global seaborne oil exports moves through that narrow passage. Even when physical flows continue, uncertainty surrounding the route can influence shipping costs, insurance premiums, freight logistics, and ultimately energy prices. Markets are not only pricing what has already happened, they are constantly attempting to estimate what might happen next. That distinction is critical. Many investors assume prices always reflect objective reality. In practice, prices reflect expectations. When those expectations prove too optimistic or too pessimistic, markets adjust, sometimes rapidly. This is where silver enters the discussion. Although silver is often viewed primarily as a precious metal, its price is influenced by several different forces simultaneously. It responds to monetary policy, inflation expectations, industrial demand, currency movements, investor sentiment, and geopolitical developments. Unlike many financial assets, silver sits at the intersection of both the investment economy and the industrial economy. That makes interpreting short-term price movements far more complicated than simply asking whether demand increased or decreased. The chain reaction begins with energy. Energy prices influence transportation, manufacturing, production costs, and inflation expectations. Inflation expectations influence bond markets. Bond markets influence real yields. Real yields affect currency valuations and investment decisions. Those investment decisions eventually reach markets like gold and silver. Understanding this sequence helps explain why precious metals sometimes fall, even when long-term demand remains healthy. It also explains why dramatic price moves often occur before any fundamental change in the underlying supply picture. The current environment offers a good example. Even after recent market volatility, the structural drivers supporting silver have not disappeared overnight. Industrial applications continue expanding across renewable energy, electronics, advanced manufacturing, and electrical infrastructure. Mine development remains a long-term process, requiring significant capital and years of planning before additional production reaches the market. Those realities change slowly. Investor expectations, however, can change within minutes. That difference between structural fundamentals and short-term market psychology is one of the defining characteristics of commodity investing. When fear dominates, prices often move further than fundamentals alone would justify. When optimism returns, the opposite frequently occurs. Experienced investors therefore spend considerable time distinguishing between temporary market mechanics and lasting structural changes. Another important factor involves liquidity. Periods of heightened uncertainty frequently trigger portfolio adjustments that have little to do with long-term commodity demand. Investment funds rebalance positions. Large institutions manage risk exposures. Algorithmic trading systems respond automatically to changes in interest rates, volatility, and currency markets. These mechanical flows can amplify price movements beyond what underlying physical markets might suggest. That is one reason paper prices and physical market conditions do not always move in perfect alignment over short periods. While futures markets respond almost instantly to macroeconomic news, physical supply chains often evolve more gradually. Industrial consumers continue purchasing material when production schedules require it. Manufacturers continue sourcing critical inputs regardless of daily fluctuations in futures prices. As a result, temporary disconnects can emerge between financial markets and physical markets. Those disconnects rarely last forever. Eventually, either market expectations change or underlying fundamentals reassert themselves. The challenge for investors is recognizing which process is taking place. At the same time, broader monetary policy remains an essential piece of the puzzle. Federal Reserve decisions influence borrowing costs throughout the global economy. Those borrowing costs affect investment behavior, business activity, currency markets, and ultimately commodity pricing. Even developments occurring thousands of miles away can influence precious metals if they alter expectations regarding inflation or future interest rates. That interconnectedness explains why silver often reacts to events that initially appear unrelated. A geopolitical development affects energy. Energy influences inflation expectations. Inflation expectations influence central bank policy. Central bank policy affects bond yields and the US dollar. Those changes eventually flow into precious metals. Viewed individually, each step may appear relatively small. Taken together, they create powerful market trends. As trading begins again, investors will be watching not only the headlines, but also how multiple markets respond simultaneously. Crude oil, treasury yields, the US dollar, and precious metals all provide different pieces of the same larger story. The key question is no longer whether recent volatility occurred. The more important question is whether the assumptions behind that volatility still hold. Because if those assumptions begin changing, the next phase of the market could look very different from the one investors expected only a few days ago. If the first part of the story is about expectations, the second part is about evidence. This is where many investors make a critical mistake. They assume that a falling futures price automatically means demand has collapsed or that the long-term outlook has fundamentally changed. In reality, those are two very different conclusions. Price can move sharply because of macroeconomic positioning, while the physical market tells an entirely different story. Understanding that distinction is essential because financial markets often experience periods where paper trading and physical demand move in opposite directions before eventually reconnecting. One of the most important areas to monitor during periods of volatility is the physical silver market rather than the futures price alone. Futures contracts reflect expectations, speculation, hedging activity, and institutional positioning. Physical demand reflects something different. It reflects manufacturers needing raw material, refiners supplying industrial customers, wholesalers replenishing inventory, and investors taking delivery of actual metal. Those forces operate on different timelines, and during periods of market stress, they do not always move together. This becomes particularly important when discussing the COMEX futures market. Every futures contract represents the possibility of physical delivery if contract holders choose that route rather than closing or rolling their positions. Most futures contracts never reach physical delivery because traders are simply managing price exposure. However, delivery activity still matters because it provides insight into whether commercial participants are seeking actual metal instead of cash settlement. Institutional traders monitor registered inventories closely for this reason. Registered silver represents metal that is available and eligible for delivery against futures contracts. While inventory levels naturally fluctuate over time, they become especially relevant when delivery interest increases. A rising number of participants requesting physical settlement naturally draws attention to available deliverable supply, even if the market continues functioning normally. The relationship between paper claims and physical inventories is often misunderstood. Headlines frequently present these figures without explaining what they actually represent. Large open interest does not automatically mean a shortage exists, nor does lower inventory immediately imply a crisis. What matters is how those figures evolve together and whether delivery behavior begins changing relative to historical norms. That is why experienced market observers pay attention to trends rather than isolated numbers. Beyond exchange inventories, another important indicator comes from regional physical markets. Premiums paid in major trading hubs can provide valuable information about local demand conditions. When buyers consistently pay above international benchmark prices to secure physical silver, it may indicate stronger underlying demand than futures prices alone would suggest. These premiums fluctuate with logistics, refining capacity, transportation costs, and regional buying patterns, but they remain useful pieces of the overall puzzle. Industrial demand continues to be one of silver's defining characteristics. Unlike gold, which is primarily held for monetary and investment purposes, silver serves a dual role. It functions as both a precious metal and a critical industrial input. Modern economies rely on silver across numerous sectors, including electronics, electrical systems, renewable energy technologies, medical equipment, advanced manufacturing, and specialized industrial processes. This broad range of applications means industrial consumption does not simply disappear because market prices become volatile. Factories continue operating, manufacturers continue filling orders, infrastructure projects continue requiring materials, technological development continues creating new applications. These long-term demand drivers evolve much more slowly than financial markets. At the same time, increasing supply is rarely a quick process. Developing a new mine involves exploration, environmental review, financing, engineering, permitting, construction, and operational ramp-up. Even under favorable conditions, bringing meaningful new production online often requires several years. This limited flexibility means supply cannot rapidly adjust to sudden increases in demand. When analysts discuss structural deficits, they are referring to periods during which total consumption exceeds newly mined production and recycled supply. Such conditions do not necessarily produce immediate price increases because macroeconomic forces can temporarily dominate trading activity. Nevertheless, persistent imbalances eventually become part of the broader pricing discussion. Another factor drawing attention is the growing strategic importance of critical minerals. Many governments have expanded efforts to secure reliable access to materials considered essential for national security, energy infrastructure, and advanced manufacturing. Silver's role in modern technology places it within broader conversations surrounding supply chain resilience and strategic resource planning. Should future policy initiatives increase official purchasing or encourage strategic stockpiling, that could influence long-term demand dynamics. Markets closely monitor these possibilities because government participation differs significantly from ordinary commercial buying. Public sector procurement often reflects multi-year planning rather than short-term price considerations. While these discussions continue, technical analysts are studying the market from another perspective. Charts cannot predict the future, but they provide insight into how buyers and sellers are behaving. During significant corrections, analysts frequently search for evidence that selling pressure is weakening or that long-term support levels are attracting renewed interest. Patterns such as higher lows, improving momentum, or stabilization following extended declines can indicate changing market psychology. These developments become more meaningful when they occur alongside improving macroeconomic conditions or strengthening physical demand. No single indicator tells the entire story. Technical analysis, macroeconomics, physical demand, monetary policy, and investor sentiment all contribute different pieces of information. The most effective market analysis combines these perspectives rather than relying exclusively on one approach. History reinforces this balanced view. Financial markets have experienced numerous corrections that initially appeared catastrophic, but later proved temporary. During the global financial crisis, the pandemic-driven market collapse, and several major commodity downturns, investor psychology often shifted to extreme pessimism near important turning points. That does not mean every decline immediately produces a recovery. Rather, it illustrates that market sentiment frequently overshoots reality during periods of uncertainty. Investors naturally extrapolate recent price action into the future. When prices rise rapidly, many assume they will continue rising indefinitely. When prices fall sharply, many assume weakness will continue without end. Market history repeatedly demonstrates that neither assumption is consistently reliable. Instead, cycles evolve through changing economic conditions, policy decisions, liquidity flows, and investor expectations. Understanding these cycles provides context that daily headlines often fail to capture. This broader perspective becomes especially valuable during periods when geopolitical developments dominate financial news. Military events, shipping disruptions, sanctions, diplomatic negotiations, and energy markets all influence expectations surrounding inflation and economic growth. Yet their effects are rarely isolated. A geopolitical event influences oil. Oil influences inflation expectations. Inflation expectations affect central bank policy. Central bank policy changes currency markets. Currency movements influence commodity pricing. Every stage of that sequence interacts with the others. Recognizing these connections helps explain why silver sometimes responds more to bond markets than mining news, or more to Federal Reserve communication than industrial production data. Looking ahead, investors should continue evaluating whether current market pricing accurately reflects evolving conditions or whether expectations are beginning to shift once again. That question becomes increasingly important whenever multiple catalysts approach simultaneously, because markets often experience their largest moves not when everyone agrees, but when consensus expectations begin changing. And that brings us to the final piece of the story. If structural demand remains intact, physical markets continue functioning, monetary policy expectations evolve, and geopolitical uncertainty remains elevated, what specific signals should investors monitor to determine whether the current correction is approaching its next major turning point? The final piece of the puzzle is not about predicting prices. It is about recognizing the signals that have historically appeared before markets change direction. No investor consistently identifies the exact bottom in real time, and no institution builds long-term strategies around guessing a single day's price action. Instead, professional investors monitor a collection of indicators that, when viewed together, provide a clearer picture of whether the underlying environment is improving or deteriorating. The first signal remains the energy market. Crude oil continues to influence inflation expectations because energy touches nearly every part of the global economy. Transportation, manufacturing, shipping, agriculture, and industrial production all depend on energy costs. When oil prices experience large moves, markets immediately begin reassessing future inflation and the likely response from central banks. If geopolitical tensions continue disrupting confidence in major shipping routes, energy markets will remain highly sensitive to new developments. Even if physical supply continues moving, increased insurance costs, shipping delays, or security concerns can influence pricing expectations well before actual shortages develop. The second signal is the US dollar. Throughout recent market volatility, dollar strength has been one of the most important drivers affecting precious metals. A stronger dollar typically places downward pressure on commodities because international buyers must spend more of their local currency to purchase dollar-denominated assets. If expectations surrounding monetary policy begin changing, the dollar could respond quickly. Currency markets often move before broader financial markets fully adjust, making them an important indicator for investors monitoring gold and silver. The third signal involves real yields. Real yields represent inflation-adjusted returns available on government debt. Because precious metals do not generate interest or dividends, changes in real yields directly influence their relative attractiveness. When real yields rise, holding gold or silver carries a higher opportunity cost. When real yields fall, that opportunity cost declines, often creating a more supportive environment for precious metals. This relationship has appeared repeatedly across multiple market cycles. The fourth signal comes from inflation itself. Markets are not focused solely on whether inflation rises or falls. They are focused on whether inflation behaves differently than policymakers expect. Unexpected inflation data can rapidly alter interest rate expectations, influencing bonds, currencies, equities, and commodities simultaneously. Investors should therefore pay close attention to inflation reports, not simply because they describe current economic conditions, but because they influence future monetary policy expectations. Another area deserving close attention is physical demand. Industrial consumption does not usually react dramatically to daily price fluctuations. Manufacturers purchase materials according to production schedules rather than short-term market sentiment. As a result, monitoring broader demand trends can provide useful context during periods of elevated volatility. Likewise, developments involving exchange inventories, delivery activity, and regional physical premiums may offer additional insight into underlying market conditions. None of these indicators should be viewed independently. Markets function as interconnected systems. A shift in one area frequently influences several others. That is why institutional investors rarely base decisions on a single headline or isolated statistic. Instead, they evaluate multiple pieces of information simultaneously. Another important lesson from previous market cycles involves timing. Recoveries often begin while headlines remain overwhelmingly negative. By the time economic optimism becomes widely accepted, many assets have already experienced significant gains. This pattern has repeated across numerous financial crises. During the global financial crisis, confidence remained extremely weak even after markets had begun recovering. Following the pandemic-driven sell-off, investor sentiment stayed cautious despite rapidly improving asset prices. The same principle has appeared in commodity markets on multiple occasions. Market psychology tends to lag behind market behavior. That lag creates both risk and opportunity. It explains why many investors feel most comfortable buying after substantial rallies and most uncomfortable buying after significant declines. Long-term market history suggests that emotional comfort and attractive valuations do not always occur at the same time. Of course, every market cycle has unique characteristics. Current conditions include evolving geopolitical risks, changing monetary policy expectations, technological transformation, and shifting global supply chains. Those factors distinguish today's environment from previous periods. Yet the broader principles remain remarkably consistent. Liquidity matters. Interest rates matter. Supply and demand matter. Investor psychology matters. Understanding how these forces interact provides a stronger foundation than reacting to daily market commentary. Silver itself occupies a unique position because it combines characteristics of both an industrial commodity and a monetary asset. Industrial growth supports long-term consumption. Investment demand responds to macroeconomic uncertainty. Government policies surrounding strategic resources may influence future procurement. Technological innovation continues expanding potential applications. These overlapping drivers make silver one of the more complex commodities to analyze. Gold follows a somewhat different path. Its primary role centers on monetary confidence, reserve diversification, and wealth preservation. Central bank activity, inflation expectations, financial stability, and currency dynamics all influence gold's long-term outlook. Although gold and silver frequently move together, their individual drivers are not always identical. Recognizing those differences allows investors to interpret market developments more accurately. Another valuable perspective comes from studying institutional behavior. Large investment firms, sovereign wealth funds, pension managers, and central banks generally evaluate opportunities using much longer time horizons than most retail participants. They focus on allocation, diversification, valuation, and macroeconomic trends rather than reacting to every short-term fluctuation. That does not guarantee success. Even sophisticated investors make mistakes. However, their analytical process often emphasizes discipline over emotion. This is perhaps the most important lesson of all. Financial markets naturally create emotional responses. Sharp rallies generate excitement. Sharp declines generate fear. News headlines amplify both. Successful investing requires acknowledging those emotions without allowing them to dominate decision-making. The most effective investors develop frameworks before volatility arrives. They identify the indicators they intend to monitor. They determine what information would change their outlook. They distinguish between structural developments and temporary market noise. This disciplined approach reduces the temptation to react impulsively whenever prices experience significant swings. As the coming weeks unfold, markets will continue processing new economic data, central bank communication, geopolitical developments, and physical market information. Each new report will contribute another piece to the broader picture. Some developments may reinforce existing expectations, others may challenge them. Markets will adjust accordingly. Rather than asking whether tomorrow's opening price will be higher or lower, investors may benefit more from asking whether the underlying drivers are becoming stronger or weaker. That question encourages a longer-term perspective. It shifts attention away from daily volatility and toward the forces that shape market cycles over months and years. Ultimately, financial markets reward preparation more consistently than prediction. No one possesses perfect foresight. Unexpected events will always occur. Forecasts will occasionally prove inaccurate. Sentiment will continue shifting between optimism and pessimism. Yet investors who understand monetary policy, commodity fundamentals, energy markets, supply chains, and investor psychology are generally better equipped to interpret those changes. The current environment reflects more than a simple fluctuation in precious metals. It represents the intersection of geopolitics, inflation, monetary policy, industrial demand, energy markets, and global capital flows. Each influences the others. Each contributes to the broader story. Whether the next major move ultimately develops next week or several months from now, the underlying process will almost certainly be shaped by those same interconnected forces. That is why experienced investors continue watching the data rather than chasing headlines, studying the mechanisms rather than the emotions, and evaluating long-term trends instead of reacting to every short-term swing. Markets will continue changing. Expectations will continue evolving, but the principles governing those changes remain remarkably consistent. Understanding those principles is often the greatest advantage an investor can possess, regardless of where prices move tomorrow.